Today, you can scan a code at a local pharmacy and settle a bill in 3 seconds. No paper, no ink, and no physical contact with a bank. In the 1980s, that same transaction began by walking into a building and standing in lines for a teller to manually verify your signature and stamp a passbook. To someone who spent 40 years inside this system, this isn't just a technical upgrade. It is a shift in how the bank actually sees the person on the other side of the counter. We have achieved instant 24-hour access, but as the physical interactions became invisible, the human connection that once held the system together began to fray. We have to ask if the race to digitize everything has effectively erased the mutual understanding between the bank and the customer. In 1981, every transaction was written by hand. At the end of the day, clerks searched through thick registers to ensure the cash in the vault matched the numbers in the ledger. There was no undo button. If the books didn't balance, the staff didn't go home. This forced proximity meant the branch manager often knew their customers by name. They understood the merchant's family, the farmer's seasonal needs, and the factory owner's local reputation. Credit wasn't decided by a distant credit score. It was based on direct observation. A banker approved a loan because they witnessed the borrower's character and business habits over years. While this manual system was slow and geographically restricted, it meant that every rupee lent was tied to a specific human face. This made both the banker and the borrower personally accountable to one another. That local focus began to change in the 1990s. Liberalization brought in private banks and core banking systems, software that pulled a customer's data out of the local ledger and into a centralized national database. Then came the ATM. Suddenly, the card replaced the conversation. You could withdraw your money at any hour without looking a banker in the eye. This was the first step toward physical detachment. Customers were no longer recognizable individuals at a specific branch. They were account numbers interacting with a systemic grid. Inside the banks, the culture shifted toward meeting aggressive monthly targets. With managers under pressure to grow their loan books, the focus moved from judging character to processing volume. As banking scaled up its mechanical efficiency, it became increasingly blind to the individual human behavior of its borrowers. A loan fails when it crosses this 90-day mark, classified as a non-performing asset. But failure rarely arrives suddenly. It starts earlier, with a single check returning for insufficient funds or failing to submit monthly stock statements. In the manual era, these issues were often resolved through a direct conversation at the branch. Today, the system waits for the default and then triggers the legal force of the insolvency and bankruptcy code. The shift from conversational problem-solving to institutional tribunals shows how the system has prioritized asset recovery over relationship management. Today's digital peak has achieved what once seemed impossible. These digital identities allow millions of people to open accounts and receive government support instantly, regardless of where they live. But as the tools became more sophisticated, so did the threats. Instead of forged paper documents, we now face invisible, scaled risks like phishing and the digital diversion of funds. A computer can perfectly verify a signature or a balance, but it cannot judge human intent. It sees the math, but it remains blind to the motive. For the modern borrower, the ease of taking a loan on an app doesn't change the legal reality. The obligation to repay is just as heavy as it was in 1981, even if the approval took 5 minutes. The ideal banking system of the future cannot rely on software alone. It must find a way to marry the speed of digital infrastructure with the irreplaceable judgment and trust of the human banker.